Assalamualaikum to the esteemed Dr. Siti Nurhidayah Imam Roslan and everyone. Before we begin, allow me to introduce our group members. I am Nurul Hidayah, followed by Mazia, Alia Nabiha, Putri Nur Sharifah Aina Alia, Nur Zafira and Akilah Maisara. Our group will be presenting an analysis of Public Bank Berhad financial performance from 2023 until 2025. For my part, I will begin with the introduction. The banking sector plays an important role in supporting economic growth and financial stability by providing services such as deposit, financing, and investment products. This report analyzes Public Bank Berhad financial performance from 2023 until 2025 using financial ratio analysis. Moving on to the bank profile, Public Bank Berhad was established in 1966 by Tan Sri Teh Hong Piao and his headquarters in Kuala Lumpur, Malaysia. Its core business segment include personal banking, commercial banking, Islamic banking, and SME financing. The bank also operates in several countries, including Hong Kong, Vietnam, Cambodia, Laos, and Sri Lanka. Next, I will discuss public bank profitability performance using the return on asset or ROA ratio. ROA measures how efficiently a bank uses its asset to generate profit. Based on the figure show, public bank ROA increased slightly from 1.30% in 2023 to 1.32% in 2024. However, the ratio decreased marginally to 1.29% in 2025. Despite this small fluctuation, the ROA remained relatively stable throughout the 3 years period, indicating that public bank continued to utilize its asset efficiently in generating profit. Let's conclude my presentation. I will now pass the presentation to Mazia.
Assalamualaikum. This is Mazia Alias presenting liquidity and asset quality for Public Bank Berhad for financial year 2023 to 2025. The loan to deposit ratio shows how much of customer deposit fund loans staying below 100%, means deposits fully cover the loan book. Public Bank's LDR rose from 96.63% in 2023, 97.90% in 2024, and 99.70% in 2025. For financial year 2025, 445,758 million ringgit in loans divided by 447,114 million ringgit in deposits gives 99.70%. This was driven by loan growth outpacing deposit growth. The ratio stayed below 100% throughout, and average LCR of 197.7% confirms sound liquidity. The gross impaired loans ratio measures the percentage of loans that are impaired where borrowers can't meet repayment terms. A lower ratio means better credit quality. Public Bank's GIL declined from 0.59% in 2023 to 0.52% in 2024 and 0.51% in 2025. For financial year 2025, 2,285 million ringgit in impaired loans divided by 445,758 million ringgit in total loans equals 0.51%. This reflects disciplined credit underwriting and is roughly 1/3 of the 1.6 to 1.8% industry average, supported by a strong loan loss coverage ratio of 149.9%. In summary, Public Bank's LDR staying just below the 100% threshold with healthy liquidity coverage. Its GIL improved well below the industry average. Together, this shows strong loan growth paired with sound liquidity and superior credit quality. The one risk to watch is LDR continuing to climb toward 100%. Thank you.
So my name is Nur Alia Nabiha and I will continue to explain about the Common Equity Tier 1 or CET1 ratio, which measures the bank's financial strength and ability to absorb loss. The CET1 ratio has shown a slight decline from 14.7% in 2023 to 13.9% in 2025. However, the bank CET1 capital increased from RM 50.9 billion to RM 53.6 billion during the same period. This decline was mainly because risk-weighted assets grew faster than capital. Despite this, the CET1 ratio remains at a healthy level and above regulatory requirements, showing that the bank is still financially strong and well prepared to manage potential risks. Next is the cost-to-income ratio, or CIR, which shows how efficiently the bank manages its operating costs compared to the income it generates. Generally, a lower CIR indicates better efficiency. Based on the data, the CIR increased slightly from 33.7% in 2023 to 34.9% in 2025. This was mainly because operating expenses increased faster than operating income during the period. However, the ratio remains relatively low, which suggests that the bank is still managing its costs effectively. Overall, the result indicates that the bank is maintaining good operational efficiency while continuing to grow its business.
My name is Putri Sharif Aina binti Megat Muhammad Wazir, and my message number is 2024489466. I will continue with part B about discussion and trend observations. Okay, I will explain first ratio, return on asset. Okay, return on asset, we measure how effectively a bank use its asset to generate profit. Since loan and investment are the main income generating asset of a bank, ROA is an important indicator of profitability. In Malaysian, commercial banks generally record an average ROA between 1.1% and 1.3%. For public bank, maintain ROA from 1.3% throughout the review period, indicating strong profitability and efficient asset utilization. Okay, next ratio, we go to liquidity ratio, which is loan to deposit ratio, or LDR. LDR will measure the proportions of customer deposit that are used for loans and financing activities. It helps assess whether a bank maintains a balance between profitability and liquidity. A ratio below 100% generally indicates that the bank has sufficient deposits to support lending activities. For public bank, record an LDR of 99.7% in 2025, which remain within acceptable limit and reflected sound liquidity management. Okay, next we go to asset quality ratio, which we use gross impaired loans ratio. Okay, that's a ratio we measure the percentage of total loans portfolio that are classified as impaired. It is a key indicator of credit risk because a higher ratio may result in greater loan loss provisions and lower profitability. The Malaysian banking industry recorded SGIR ratio from 1.6% to 1.8% in recent years. So public bank ratio was only 0.51% in 2025, significantly lower than the industry average, which is acceptable. Okay, next we go to common equity tier 1 ratio. That's compare a highest quality capital. It is an important indicator of capital adequacy because it shows the bank ability to observe unexpected losses and remain financially stable during periods of economic stress. Under B&M Basel III framework, banks are required to maintain a minimum CET1 ratio of 4.5%. In addition, bank must hold a capital conservation buffer of 2.5%. Since public bank is classified as a domestic important bank, it's required public bank to maintain an additional 0.5% buffer. Therefore, the effective minimum CET1 requirement is 7.5%. During the review period from 2023 to 2025, public bank required CET1 ratio range from 13.9% to 14.7%, which is almost double the regulatory minimum. This indicates that public bank was nearly double the effective regulatory minimum. Okay, now we go to last ratio, which is cost to income ratio. Cost to income ratio, we measure the proportions of operating expenses relative to operating income. It is widely used to evaluate management efficiency in banking. A lower CIR indicates that a bank is controlling its costs effectively while generating income. And public bank report a CIR range from 33.7% to 34.9%, which is significantly lower than the industry average of 43% to 47%. This highlights public bank's strong operational efficiency and effective cost management.
Assalamualaikum and hi everyone. My name is Siti Zarfa Beti Zakaria. My number metric 2024854884. Now I will continue the presentation. let's start with profitability and management efficiency. As we can see, public banks and ROA remain quite stable at around 1.3% from 2023 to 2035. This tells us that the bank was consistently generating profit from its asset, even though the bank's total asset increased over the 3 years. Its net profit also grew steadily, which helped maintain a strong ROA. For management efficiency, we look at the cost to income ratio or CIR. The ratio increased slightly from 33.7 to 34.9%. It was mainly due to higher operating costs, especially staff expenses and investment in digital banking services. However, the good thing is that the CIR remained below 35%, which is still better than many banks in the industry. So overall, public bank remain highly profitable while maintaining good cost efficiency. So now let's moving to liquidity and asset quality. The LDR increased in 2023 to 2035. This means that loan growth was faster than deposit growth during the period. Although the ratio is getting close to 100%, it is still within an acceptable range. This showed that public bank was able to support lending activities without relying heavily on external funding. Next is the GIL. We can see that improved from 0.59% to 0.51%. A lower GIL ratio means fewer problematic loans and better asset quality. It also showed that public bank managed its credit risky very well and maintained a healthier loan portfolio compared other than industry average. Overall, the bank successfully expanded its lending activities while maintaining strong liquidity and excellent asset quality. Then lastly, let's look at capital adequacy. The CET1 ratio declined slightly. If you can see the slide, it's slightly from 14.7 in 2023 to 13.9% in 2025. This happened because the bank expanded its lending activities, causing risk-weighted asset to grow faster than its capital. Even though the ratio decreased, there is no major concern because it is still well above the regulatory minimum requirement set by BNM. This means public bank still has a strong capital buffer and is financially capable of absorbing unexpected losses if needed. To conclude, overall public bank demonstrated strong profitability, effective cost management, sound liquidity, excellent asset quality, and adequate capital strength throughout 2023 until 2035, reflecting its stable financial performance and resilience within the Malaysian banking industry. That's all from me. Thank you.
Thank you, Ifah. Now, I'm Akila. I'm going to continue for part C. For the overall commentary, public bank can be considered a strong and stable bank based on all 5 ratios on the list. From 2023 to 2025, the bank maintained stable profitability with a return on assets remaining around 1.3%. The bank also recorded good loan quality as shown by the low gross impact loans ratio of 0.51% in 2025. This indicates that the impaired loans were kept under control through effective credit risk management. In terms of liquidity and capital strength, public bank maintained loan-to-deposit ratio below 100% and a common equity Tier 1 ratio of 13.9%, which remained well above the Basel III minimum requirement. This result suggests that the bank was able to support business growth while maintaining financial stability and managing risk effectively. To further evaluate public bank's performance, a comparison was made with Maybank and CIMB using 3 key ratios, which are cost-to-income ratio, gross impact loans, and common equity Tier 1 for year 2025. Public bank recorded the lowest cost-to-income ratio at 34.9% compared to Maybank at 48.8% and CIMB at approximately at 47%. This shows that public bank managed its operating costs more efficiently than both competitors. For assets quality, public bank also performed better with a gross impact loans ratio of only 0.51% compared to 1.28% for Maybank and 2.2% for CIMB. This suggests stronger loan quality and lower credit risk. Although Public Bank's Common Equity Tier 1 ratio of 13.9% was slightly lower than CIMB, which is 14.3%, it remains strong and above regulatory requirements. Overall, public banks perform well across all three areas and compared positively with their peers. If advising an investor today, public bank would generally be viewed as a suitable choice for investors looking for stability and consistent performance. The bank maintains steady profitability, good loan quality, healthy liquidity, and a strong capital position throughout the period. However, one area that should continue to be monitored is the cost-to-income ratio. The ratio increased from 33.7% in 2023 to 34.9% in 2025, which means operating expenses grew faster than income. If this trend continues, it might put pressure on future profitability. Therefore, management should continue focusing on cost control and operational efficiency while supporting business growth. Overall, Public Bank remains financially sound and well-positioned for long-term growth. Thank you everyone for your attention.